Hi, my name is Cassandra Crowe and I'm the Research Manager for the MLC Multi-Asset Strategies. Today I'm very excited to interview Ben McCaw, Senior Portfolio Manager for MLC. Welcome Ben, thank you very much for joining us.
Thanks Cass.
Ben, it's certainly been an interesting time for investment markets. When you look at traditional assets like bonds and equities, valuations look extremely stretched, and when you think about monetary policy, it's potentially coming to the end of its effectiveness. I've even heard you say that we could be at the beginning of the end of an era. Can you perhaps explain a little bit about what you mean by that statement?
For us and our team, it's felt like the beginning of the end of an era for a little while, but there's a few more signs now that that might in fact be true. As most investors are aware, the feed-through of changes in monetary policy to the real economy and the financial side of the economy are extremely complex, and we've been in almost like a one-way street on monetary policy now for about 20 years. So, you've got to forgive people for just becoming ingrained in this environment of lower and lower interest rates to the point at which the price of cash became extremely distorted. But I think that the signs that are pointing us towards thinking that the end of the era may be closer now than it has been in the past are simply feedback that we're starting to see from society back through the political system. So for instance, if we think about monetary policy and its impact on the economy, there's a feedback mechanism that goes through the financial side of the economy, which has performed very well over the past 5 or 6 years for sure. I mean, asset prices now are extremely high. But the feedback through the real economy hasn't been nearly as strong in terms of stimulating demand. That's changed slightly recently, but the wealth gap that's opened up, for example, is, I think, putting pressure on politicians to start thinking much more seriously about using fiscal policy to stimulate demand. And that in turn can turn around and impact monetary policy and force rates up again.
You mentioned asset prices, and I guess I wonder, do you think they will continue to be as high as they have been in the past? We see a lot of fund managers positioning their portfolios as though they potentially might continue to be high, but my concern is they might not be aware of some of the risks embedded within those positions.
That's a really good question, and I mean, from our point of view, it's hard because we don't pretend, we never pretend to know what's going to happen tomorrow. So we have no idea whether high asset prices are going to maintain themselves for a short period of time, a medium period of time, or a long period of time. But one thing we do understand is that things can change, and we believe we've got a fairly strong understanding of how asset prices will react if certain things change in the environment. So rather than investing as if tomorrow was going to be the same as today, we take an alternative route and think about different futures and try to put together a strategy that will deliver to clients regardless of what happens in the future.
Thanks, Ben. I understand foreign exchange is often used as a diversifier to global equities. I know you have some positions in place with respect to the Aussie and the USD. Can you comment a little bit on those?
Sure. This is related to the comment I made earlier about high asset prices. Sometimes it's not easy to take advantage of a high asset price, and sometimes it is. And so with the peculiarities of the environment over the past 5 years or so, one of the markets that has been able to be accessed by investors like us, where there is opportunity, is in currency markets. And it's not just the Aussie dollar and the US dollar, it's a whole mix of currencies. But because of the actions by central banks to manipulate interest rates, that's created some really good opportunities for us to access diversification in the context of otherwise finding it very difficult to be able to diversify against the types of equity risk that dominate the portfolio.
In terms of Aussie equities now, I know you and the team actually built an in-house bespoke portfolio for your real return fund, Inflation Plus. Can you tell us a little bit about why it's so important to have a tailored Australian equity portfolio?
That's right, Cass. For quite some time now, we've been managing an Australian equity component within Inflation Plus. The reason for us thinking about or developing the capability to manage a direct equity allocation within our diversified funds is because it's become clear that we need to be able to align the stock selection and the asset allocation to engineer the outcomes that we have been trying to deliver to clients. And taking control of stock selection in an important sector like Australian equities is our first step towards doing that. So just by way of example, to illustrate how this helps us out, most investors would be aware that the Australian market is dominated by financials and materials, right? But there's also opportunities in Australia outside financials and materials. The way we manage portfolios, it would be very difficult for us to maintain a meaningful weight to Aussie equities if we had to take the concentration risk from financials and materials. So we can handle that obviously by building our own portfolio. But there's another side to it as well. Banks, for instance, in Australia at the moment trade on quite a good dividend yield, which under most scenarios is attractive for our portfolios. The problem though is that if the Australian economy goes into swings into the type of environment that challenges the banks, then we're at risk from a capital point of view, and that's something that we can't tolerate. So our solution to that is to participate in the banks and own them, not to the extent that the market owns them, but to about 10%, but to hedge the capital side with puts. Now, the beauty at the moment is that we can collect quite a healthy dividend income from the banks, but the puts are cheap. So the way we look at it is that we've enabled ownership of banks to receive a relatively high dividend, where we give up a little bit of that dividend, but get the protection from the puts, so that if the market does correct, we don't lose on the capital side.
That's great insight. Thank you very much, Ben, for sharing your thoughts with us today.
Thanks for having me, Cass.
You're welcome.